I want to talk to you about the strategy of how to do that. Like, how do you actually implement that in a way that makes sense? And in some cases, you could even pay this property off or properties off in 5 years or less. It's definitely possible. Welcome to the podcast, Real Estate Investing with Coach Carson. I'm your host, Chad Carson. You can also call me Coach Carson. And this is a show to help you build a profitable and passive rental property business so you can get out of the financial grind and do more of what matters. Whether you're a brand new listener or a longtime listener, thank you for being back for another episode. The title of this episode is How to Pay Off Rental Property Debt in 5 Years. So this is a follow-up to an episode we had recently. It was episode number 293, where a friend of mine, Arian Shihai, and I talked about the 4 reasons you should consider paying off rental property debt. And this is also a big topic in my new book, The Small and Mighty Real Estate Investor, which is now available. If you want to go check it out, I'll have a link in the profile and also in the show notes for this episode. But this is an important topic in the book because keeping your investment portfolio, your rental properties, as a small and mighty portfolio sometimes means at some point in your career, reinvesting your cash flow, reinvesting your savings into paying off debt. Now, I'm going to review real quickly why that might be something you want to consider. We talked about this more extensively in that episode that I referenced earlier. But number one, this is a way to reduce your risk. So it's not necessarily for everybody. If you're brand new as an investor, you're just getting started, using the tool of debt, of leverage is a great tool. It's going to help you get started with a little bit of money. And if you're growing your portfolio, using the BRRRR strategy, using seller financing, using private financing, having some kind of debt is going to be a necessity for most of us getting into real estate investing. But what I'm talking about here, the reason I say reducing risk is the first benefit of paying off debt, is that as you grow, at some point you're going to get to a threshold, and I talk about that a lot more in the book, how to identify when you are transitioning from a wealth builder to someone I call in the book an ender or a harvester, where you're trying to live off your income, where you're trying to transition to a phase maybe where you leave your job or you go part-time. The point is you want to actually use this wealth, this investment portfolio that you've built. And so paying off debt is a way to reduce the risk so that you don't go back down the wealth building mountain. You can think the worst thing you can think of, as Warren Buffett and other people who are longtime investors say, is to sacrifice the things you already have, the wealth you already have, to try to get something you don't really need. So the point is you have enough at this point, and so reinvesting your profits into reducing your risk, because things can happen, economies can change. Even if it's a very small probability that rents go down or prices go down, or you have a lot of vacancies in your rental properties and you can't make your mortgage payments. Like, those are probably small chances, and you're willing to take that chance early in your career. But as you move further along, taking that risk off the table and that unknown is a smart thing to do. So that's the first reason to consider it. The second reason is, as you're trying to use your portfolio as something to live off of, you want to increase your income. So very often when you're growing, your cash flow, if you have it, is often like a roller coaster. It's up and it's down. And over time, the rents start going up, hopefully, as you're holding your properties. But also over time, you're paying your loan down. But paying your loan down, if you owed $200,000 in the beginning and $125,000 now, your payment doesn't change. It's the same. And so you have more equity. The property's gone up in value. Your payments gone. Your loan balance has gone down, but your payments are the same. And so by paying off your debt, you can actually increase your income a significant amount. Sometimes 5 or 6 times more cash flow than you had before paying off the debt. And yes, you could reinvest that capital and go buy something else and have more cash flow, but that would involve having more properties and more risk, more hassle. And that's the third benefit I want to talk about, is that being simple and having a simple portfolio, whatever that means for you. That could mean 5 properties, that could mean 30 properties, depending on what your goals are. But having a simpler portfolio reduces the hassle, and it allows you to have the flexibility to do whatever it is that matters to you. For example, with my family's case, we like to travel. And so we're just wrapping up as I'm recording this, living 12 months in Spain. And my kids went to school here. I took Spanish classes. I got to know people locally. My wife taught English. And so being able to do that has a large part to do with what your rental property portfolio looks like. I'm not buying and selling a lot of properties. We buy some here and there, and we have a stable portfolio. We have paid off a lot of our properties. We've increased our income. And so that gives me peace of mind to be able to do these types of things and the types of things you want to do in your life that were the goals you set out to do in the first place. So in review, number 1, reducing risk. Number 2, increasing income. Number 3, increasing the simplicity and the hassle factor of your portfolio. And then number 4, which I think is a really interesting one, is it gives you a goal to shoot for. Because when you're climbing this mountain of wealth building, it's a pretty long grind, even 5 years, which I'll talk about in this episode, but maybe 10 years, maybe 15 years. That could be a long time to have to stick with a plan and just wait for properties to go up and wait for things to happen passively. And so by actually having a plan to pay off debt at some point, maybe you have a loading phase where you buy properties and you acquire a certain number of properties, and maybe you get to 15 properties, and now you start saying, all right, at this point, I'm going to start reinvesting on my cash flow into paying off one property at a time. I'm going to talk about that technique here in a moment, but that gives you a very specific plan, and our brains need that kind of discipline. We need somewhere to put our money. Otherwise, the money gets spent. If we lack a discipline, a self-discipline of a plan, sometimes it's easy to go off the rails. We know that with diets. We know that with exercise plans. It works the same way with wealth building and trying to achieve financial independence. So I wanted to start this conversation off with just reviewing those benefits. Definitely go back and listen to that episode. It was a really good conversation, a back and forth between two investors who believe in this strategy, who help other people do this strategy, and just talking about how that works in real life. So if you're convinced, or if you're at least curious about getting to that stage, whether you're already at the stage where you might want to start paying off properties, or whether you're just kind of early in your career, but you'd like to know where you're going to go and what the plan looks like, I want to talk to you about the strategy of how to do that. Like, how do you actually implement that in a way that makes sense? And in some cases, you could even pay a property off or properties off in 5 years or less. It's definitely possible. So I'm going to give you 4 different practical ways that you can pay off debt on your rental properties. I'll go into detail on each one of those. But before we get into that, I want to give you a sort of tool that you can use to measure your progress in paying off debt, both on an individual property basis and also on a portfolio basis. So all of your rental properties together. And that tool is something called measuring your loan to value ratio. Sometimes you'll see an abbreviation of that called LTV. So in some ways, this is a very basic concept, but what you're doing is you're measuring the ratio of how much debt you have on the property, so the loan value, so whatever you owe at a certain period of time, compared to whatever the value of the property is. So this is typically the appraised value of the property, or if you get a real estate agent to give you a comparative market analysis, you just want to know the rough idea of what the value of the property is. In some cases, when you're brand new and you just bought a property, the value of the property might be the same as what you paid for it. Sometimes that's the case. Sometimes there's good deals to be had that are good long-term properties that you paid pretty close to what the value is. I've done that in some cases. Other cases, you might buy properties as you get more advanced and you're looking for good deals, especially fixer-upper type properties. Maybe you can buy it well below the value of the property. So your purchase price isn't necessarily the same as what the value of the property is. But what we're trying to measure in this case isn't the price that you paid for it compared to the value of the property. We want to look at what the debt is on the property. So let me give you a couple of examples on a property by property basis. So if you're a brand new investor and you're doing a house hack and you're able to get an owner-occupant loan to buy a duplex, for example, and let's say you could get a 5% down payment on that duplex. That's definitely possible. There are owner-occupant loans out there. You'll have to pay what's called a mortgage insurance premium on top of your principal and interest payments. But just to get started, it makes a lot of sense in many cases to do that. But because you put 5% down, the other side of that equation is your loan to value ratio, if you paid 100% of the value of the property, would be 95%. So let's just say easy numbers, because not that this is the real numbers in your market, but just to make the math easy, if you paid $100,000 for a property, put $5,000 down as a down payment, $95,000 loan, that's a 95% loan to value ratio. All right, so that's one example. Let's say on another property, you're buying a rental property for $200,000. This is just a pure rental property, and you put 30% down, a larger down payment. So you would have, in that case, that's $60,000 down, and you have a $140,000 loan on that property. And let's again say that that's the purchase price and the value are the same, just to keep things kind of simple. Then you would have a 70% loan to value. That's $140,000 divided by $200,000. So that's the concept. I think you get it at this point, what that tool is, but it's handy because if you want to measure your progress on a property by property level, you can every year just say, all right, I'll pay the loan down a little bit more and the property's gone up a little bit more. And this is a good thing to track, by the way, because you're figuring out your equity in the property, because one of your main goals as a real estate investor is to see your equity increase, and you want to track that. And so you can track your equity, and then the same formula basically is tracking your loan to value ratio. And so I just have a spreadsheet that I do this with and have my properties, and one column's the value, one column's the debt, and another column might be the rent, things like that, just some of the essential type numbers. But you track the loan to value on a property by property basis, and then you can do it overall at the bottom of that spreadsheet for your entire portfolio. And what I want to convey to you here is that the useful tool is that over time, you want to see your loan to value ratio on your portfolio go down. That is a more stable, healthy portfolio. If I'm not a stock investing expert, I buy index funds and just pay attention to that in addition to real estate. But if you were looking at companies on an individual basis, some of the most mature companies out there, the S&P 500, wealthy companies that produce a lot of dividends, a lot of income, as they mature as a company, they often have very little debt compared to that value of that company. So they might have like a 25% or a 20% or even a 0% loan or debt to value of that company. So if it works for big corporations, it also works for wealthy individuals. Some of the wealthiest people I know have reduced their debt level because, again, go back to Warren Buffett's quote, why risk something you already have, this wealth, just to make a little bit more, a higher return on investment, a little bit more money? It doesn't make sense at some point when you have enough wealth, when your goal changes from growth to also having growth, but balancing that with reducing risk, having low hassle, increasing your income. And so loan to value is a way to measure, almost like taking the pulse on your portfolio to see where you are. And when I first started, my business partner and I got pretty good at finding deals that we could buy below value. And we would find deals that we were all in for 70%, 75% sometimes. And we were able to borrow almost all of the money from private lenders, from sellers, from different sources, sometimes doing a BRRRR strategy where we bought it with private money and refinanced it. But in general, we were at about a 70% loan to value as new investors. Many of you, when you're first starting with house hacks, like I mentioned, you might be at 85, 90, 95% as a new investor. And if you have a long-term horizon, if you have a long-term fixed interest mortgage, that eventually you want to pay that down, but that's not a big deal when you first start. So the point is, as a starter, maybe 95% to 70% would be kind of the range that you might see your loan to value in. As you grow as an investor, it's naturally going to happen that you're going to pay your loans down. It's naturally going to happen if you're buying in good locations and doing the things I talk about, buying good properties in good locations in the Small and Mighty Investor book. There's a big chapter in the book there. You're going to have properties that go up in value as well. So the spread between your debt and what the property's worth is naturally going to go up. And so if you start off at 70% loan to value, you're going to go down to 65% and 60% and 50% eventually. And this happened for us as well. And it's one of the ways you can tell how mature your portfolio is by seeing how your loan to value just kind of naturally starts going down. Now you could, if you wanted to, refinance properties and kind of increase your loan balance and then reinvest that money somewhere else. Hopefully you're reinvesting that money well. But I think it's a good measure of your overall portfolio if that overall number is going down. And so what would a mature portfolio look like if you're in the ender phase or the harvesting phase? It might look like a 25%, 30% loan to value. At least this is my opinion. Some people might want to be a little more aggressive, all the way down to a 0% loan to value ratio, meaning you paid off 100% of the debt on your properties. I think anywhere in the 0 to 25, 30% is a reasonable place to be if you are in the mature phase of your rental property investing career. So that is a tool, loan to value. Practice it. Look at your own properties. If you already own rental properties, I encourage you to press pause now or make a note once you're not listening to the podcast to go figure out the loan to value on your portfolio. Just do rough numbers. You don't have to get crazy with the math there, but this is an important kind of takeaway exercise you can do that'll make the lessons I'm about to teach you on how to pay off your debt a little bit more useful. Okay, so now I want to get into the 4 different ways that you can pay off your rental property debt and actually do that a lot faster. And the first one I want to talk about is actually a little counterintuitive. It's called a strategic refinance. That's what I call it in the book, The Small and Mighty Real Estate Investor. And stick with me here. This is a technique that sounds a little different because, hey, you're not saving up the money and paying off the debt, but you're actually refinancing one property and using the cash that you pull out on that refinance to pay off another property. So I'm going to give you a real example with real numbers, but the benefit of this is you don't have to wait until the end of your career when you've saved up a lot of cash to do it. It's a way of kind of tweaking and improving your portfolio along the way. And it's a way that you can increase your income, reduce your risk, some of those benefits that I talked about earlier, in doing that earlier in your career. And let me give you an example. And this is very similar to what happened when my business partner and I figured out how to do this ourselves. We had properties that were plus or minus about $200,000 value properties. And these properties were very similar. Each of them had a debt right now of $80,000. So $200,000 property number one, $80,000 debt number one, $200,000 property number two, $80,000 debt number two. And just to keep things simple, the payments were about the same. So let's just say $675 per month on one property, $675 per month on the other property. So the total mortgage payment between those two properties was $1,350. Now the strategy here is that you refinance one of those properties using about an 80% loan to value. So you're going back and pulling out equity from the one property. Now you might be familiar with this if you've ever heard of the BRRRR strategy, where you buy a property, you remodel it, fix it up a little bit, you get it rented out, and then you improve the value of the property. So you then refinance it and you use that money to pull back out, pay yourself back, and then you go buy another property with that money. Well, instead of pulling out the money with a cash out refinance and buying another property, what we're doing in this case is paying off the debt on the second property. So let's just look at these numbers and how that would work. You get a new 80% loan to value loan on property number one. So using real numbers, that's about a $160,000 loan. Now I know interest rates have fluctuated a lot, and so today they're not as low as they were 3 or 4 years ago. Maybe you have to get a 6% loan now, maybe a 7% loan. I'm going to use an example using a 5% loan because I think eventually, you're going to see 5% loans someday. Might be a year from now, might be 5 years from now, but go with me on this example. Let's say you could get a 5% interest loan, $160,000 balance. Your payment would be about $859 on that new loan. So let's look at what happened. Before you had $1,350 in payments. Now you have one loan with $859 payment. So that's like almost a $500 difference between your payment before and your payment after. So you've increased your income without changing the loan to value overall of your portfolio. One property has more loan, another property is completely free and clear. So you freed up the income from your loans by refinancing it. That's part number one. So that's a benefit, right? You now have an extra almost $500 per month that you can use to save money to pay off more debt, to use it to buy more properties, whatever you want to do. Benefit number one's income. But the second benefit, which you might not think about right off the bat, is I think you've reduced your risk. And this is an idea I got originally from John Schaub, one of my mentors who wrote the book, Building Wealth One House at a Time. I first heard him explain this concept. And his point was, if you have one property that's free and clear, another property that's 80% loan to value, you have the property that's free and clear has very little risk. If you have decreasing rents, you have a Great Depression, you have a calamity, whatever happens, whatever the things you're worried about, it is a less risky situation having a free and clear property. But you might make the point, well, you owe a lot more money on that other property, so isn't that more risky? Maybe, maybe not. My experience in the Great Recession, 2007, 8, and 9, I had friends who were investors who had done very similar situations to this, owned properties for 5 or 10 years, paid their loans down. They had loans that were 40, 50% loan to value, and then they had their loan come due, meaning they had a balloon note, which happens a lot in commercial notes, and the banks were all saying, give me your money. I'm not going to loan you any more money. Originally, they had said, yeah, come back to us. We'll extend your loan. Don't worry about it. Well, my investor friends got caught in these situations where the bank said, pay us the money. And you know what happened? They were threatening to foreclose on them. And so these investors had to go wholesale their properties at very low prices and lose most of the equity that they had in that property. So the bank has all the leverage when you owe less money. So as you get down to 40 or 50%, you may think the bank is your friend, and they are friendly. I'm glad we have banks who can loan us money. But when the rubber meets the road, when you get into a tough situation, they're not going to be on your side. They have a job to do. Maybe the loan gets sold to another bank who doesn't know you at all. And so you got to think for yourself. You got to look out for yourself. And owing 80% to a bank is a different situation than owing 40%. Why is that? Because they know if they take that property back, there's a greater risk that they're going to lose money. So they're going to be more than likely more willing to negotiate with you, more willing to renegotiate terms, to do things differently, adjust the interest rate, whatever that might be. And I'm not saying you're going to get into that situation. Nobody thinks they're going to be in a tough situation, but we're thinking about worst case scenarios here, risk. And so my argument, John Schaub's argument, is that having Instead of having two 40% loan to value properties, having one at 80%, one at 0% is actually a less risky situation. So this first technique is just a way, it's kind of a baby step into paying off your debt, paying off your properties. It's a way of restructuring the capital on your portfolio. And as I said, you can already get some of the benefits of paying off your properties later on. The second technique to pay off your rental property debt and do it even faster is another counterintuitive one, but it's very important today with higher interest rate environment. And this idea is simply to pay cash when you buy new properties. So let me set the stage for this. Let's say you already own 10 rental properties. You have several loans with 3% interest rates, maybe some with 4 or 5% interest rates. And so you're facing the prospect that you want to reduce your risk. You're buying into this idea of maybe incrementally paying a little bit of debt off, but you just can't stomach going and paying off a 3% debt, a 4% debt, a 5% debt. That's just not what you want to do at this phase because you still want to grow a little bit more. You want to simultaneously grow while also kind of buying into this idea of decreasing your loan to value ratio, reducing risk, increasing your income. So there's an alternative. So maybe you save up your cash flow for the next year or so, or maybe you already have some money from your job, whatever the case might be. Let's say you have $150,000 saved up. And this can happen when you have a more mature portfolio and cash flow starts coming in and you have a good job. And you have that $150,000, instead of paying off one of your debts, the next property that you buy, the next rental property that you find, maybe go pay cash for that. So you still keep the debt on the other properties. You're still getting the benefit of those low interest rates. But this new property you have is free and clear. You have 100% of the income coming to you instead of going to a bank. You have reduced your risk. All those benefits that I talked about of having your properties free and clear, you get that on this new property. And then maybe you save up some money from that. And then the next property you buy, you pay cash again. And even if you don't pay cash, one of the things we did from a practical standpoint was instead of getting, the max leverage we could, we started paying 50% down or just larger down payments and then eventually paying those loans off down the road. That's sort of a stair-step way to do the same concept that I'm talking about here. The point is you're borrowing less aggressively than you did before, and you're taking advantage of what the market's giving you. If you're having to go out and borrow 7% interest rates today, not borrowing that money, just paying cash for a property is the equivalent of paying off a 7% loan. So it's a way to kind of sneak into getting started in this process. And this works very well for those of you who are further along in your portfolio, find yourself with some extra cash, but you're not sure how to allocate that and when to pay off the debt on your other properties. All right, so we've talked about the first two. One is a strategic refinance. The second is just paying cash for new properties. Those might be ones you haven't thought about before. Hopefully those are helpful. But now I want to get into a third technique, which is kind of a classic technique that you've probably heard about in the personal finance world, and it's called the debt snowball. But I want to make an adjustment here. We're going to call it the rental property debt snowball. And if you've never heard of this, the way this works is there's a strategy in personal finance where if you're trying to pay off credit card debt or personal debt, a lot of people think I'm just going to pay a little bit extra to each one and eventually I'll get it paid off. Now, while that might seem like it makes sense to distribute your cash flow a little bit and try to pay a little bit to everybody, it's the wrong approach if you actually want to get out of debt faster. It's the wrong approach financially, like calculation-wise, and it's also the wrong approach psychologically. A better approach is to take 100% of the cash flow you can save. Let's say you can save $1,000 per month and you're paying off your credit card debt, and you attack one debt at a time. And you probably want to list all of those debts. And there's different approaches here. You can list all of your debts with the one at the top's the smallest. So if you have a $1,000 credit card bill or a $50,000 rental property debt, that would be at the top of the list. And your house debt or your car debt that's $20,000 or your $300,000 rental property debt might be at the bottom. You can do it by order of size. You can also do it by the riskiness or the high interest rates. I kind of do a combination of that when we're paying off our own debt. We look at the amount of the loan. We look at whether it has any dangerous features to it, like if it's a commercial note with a balloon note, that gets put towards the top of the list that I want to pay off or refinance. If it has a high payment compared to the value of the property, like I talked about earlier, that goes to the top of the list. And usually if I look at 3 or 4 factors like that, then I can then say, all right, this one at the top is the one I want to pay off first. But the point is, you take all of your cash flow and you attack one debt. Whichever one's at the top of your list, attack that one first. And by concentrating all of your cash flow, you aggressively pay that debt off. And instead of a 30-year loan or a 20-year loan, you can pay that debt off in a couple of years. I challenge you to do the math yourself. Go find a financial calculator, go find an amortization calculator, and take your existing mortgage, whatever the balance is, and increase the payment by, let's say if it's a $1,000 payment now, make it a $3,000 payment or a $5,000 payment. See how long it takes to pay that loan off. It's pretty fun to think about that you can aggressively pay this loan off. Now the snowball comes in is that as you pay off that first loan, you now free up $1,000 from that debt that you were paying before. And so now you add that to the snowball. Let's say you were able to save $5,000 per month before. Now you add $1,000 to that snowball. Now you're saving $6,000 a month, and you aggressively attack the second debt. You pay that one off faster, and then now you freed up another $1,000 or $1,500, and you add that to the snowball, and on and on and on. And so this is a way that you can incrementally pay off properties. The first one takes a little bit longer. The second one takes a little bit less time. The third one even less time, to the point when you get to the last debt, it's going really fast because that snowball is getting really big. Now I told you this has a mathematical benefit in that if you're paying off the highest interest debts first or the riskiest debts first, you're getting those debts out of your life. That's a good thing because then it's going to accelerate your progress. It's going to get easier and easier and easier. So there's a mathematical benefit to it, but there's also a psychological benefit. And I think this is the bigger one. As someone who plays sports in college and has always enjoyed sports, I understand how big a deal it is to have your psychology right, to be motivated, to have a plan that you can execute and that works. And the rental debt snowball is a plan that you can execute and you can apply, and it helps you have some structure to your financial freedom journey, especially towards the end of it. Those last 3 to 5 years when you're trying to turn equity into something you can actually live off of, a rental debt snowball is a great tool for that. So this brings us to the fourth way that you can pay off your rental property debt and do it even faster. And it's also a more practical way, especially for those of you who are in higher price markets who might look at the large amount of debt that you have and you're like, oh my gosh, I got a $500,000 debt. How am I ever going to save up enough cash flow to pay that debt off? Well, this next technique might help you out with that. And what I call this technique is buying more than you need and selling the extras. So the way this might work, imagine that you want to eventually have 10 rental properties. You've kind of worked the math backwards. You've used the exercise that I have in the Small and Mighty Real Estate Investor book to figure out approximately how many rental properties you need to achieve your financial independence number from an income standpoint. But let's say your strategy is to use the debt snowball that I talked about, but also to add on another strategy of buying more properties than you need. So maybe you need 10 properties because they'll give you $10,000 per month or $120,000 per year once they're paid off. But instead of just buying 10 properties and just trying to pay those off one at a time, you buy 15 properties or maybe even 20 properties. So you buy 50%, maybe even 100% more than you need. And the interesting part about that is the equity increases on all of your properties. Maybe you've gotten really good at later in your career at buying deals well below their value, but maybe those deals aren't the ideal long-term keeper rental property. Maybe they're okay, but they don't cash flow as much. Maybe you're in the Bay Area of California where you have a property that's worth $1.2 million, and you owe $500,000 because you bought it for $600,000 or $700,000 a while back, but that doesn't cash flow very well. Like you're still just making the mortgage payment and you're not making a lot of cash flow. Well, if you owned several of those properties, what you could do is sell that property. And in this case, instead of doing like a 1031 exchange and buying another property, you would actually pay the tax on the gain that you're going to have on the property. So you're going to pay tax. So that amount of money you're going to make, let's use that $1.2 million property as an example. Maybe you pay a couple $100,000 in capital gains tax because you had a really big gain, a $600,000 gain. Well, you pay your tax, and what's left over you use to pay off the debt on your keeper properties. So it's almost like chess. Some of the pieces on the board were meant to be sold. You weren't planning on keeping that property for a long time because its job description was to grow, was to increase your equity, and then the job description of these other properties was to produce the cash flow and to hold them for the long term. Maybe they're better low maintenance properties, maybe the location's a little bit better, and so you sell those properties, you pay the tax, you use the leftover money to pay off the debt on the other ones. And so this can happen a lot faster as you get good at buying properties. So you might have a 5-year growth phase where you buy a lot of properties, especially if you're good at buying them. That's what happened to me and my business partner in our case. We were really good at buying properties, but we decided to not keep expanding our portfolio by selling off some of the ones we had. And so we did this aggressively. We sold a lot of properties. We paid taxes on them. We used those gains to put them in the bank, to put them in our debt payoff savings account. And instead of waiting 12 months or 15 months to have enough money to pay off a debt, it happened in a couple of months after selling the property. So this is a strategy I suggest you think about. Don't think about it as an all or nothing type strategy with any of these. Like any tool you have in real estate investing, the debt snowball by itself is good, but combined with the strategy of buying more than you need, selling the extras, you can put those together and accelerate your progress even faster. And you can also combine this with other strategies. For example, you might sell one property and say, I want to buy another property. Like I'm selling this single family house in Austin, Texas, and I want to buy a 5-unit or a 10-unit building in another market where cash flow is a lot better than it is in Austin, Texas, because I want to live off the cash flow. So in that case, you might do a 1031 exchange where you sell the property, you don't pay any taxes on it, you use a 1031 intermediary to hold the funds, and you've already identified, hopefully, a property that you're going to buy. And so you can do that in combination with these strategies. Because at this stage of the game, and this is really the point of this whole episode, is to help you think as an asset manager. As you get into these later stages of your career, whether you're there now or whether you're kind of thinking about getting there, you want to think about not just trying to grow your portfolio, you're trying to optimize your life. You're trying to take this portfolio that you have and to simplify your life, to increase the income, to reduce your risk, and you want to use all the tools you have. If you can sell a property and replace it with another one using a 1031, beautiful. If that increases your income, if that accelerates your progress towards your goals, that's a great tool to do it. If you can use a debt snowball to pay off a couple rental properties and do it faster, that's a great tool. Do that too. If you can buy more properties than you need, you buy 3 properties, sell 2 of them, keep 1 of them, and that accelerates your progress towards your goals, perfect. The main point of my book, The Small and Mighty Real Estate Investor, is to give you the toolbox. And then it's kind of like the toolbox is in the middle. Those are the techniques that you can use, just like what we're talking about today, but they're wrapped in the strategy. And the overall philosophy of a small and mighty real estate investor is to work it backwards. You start with your life goals. You start with what you want to accomplish. You want to start with the things that matter to you. In our case, travel, living with our family, having flexibility, being able to be an entrepreneur who tries new things, whether I make a lot of money or not. Like I have a nonprofit that some friends and I started in our hometown to build a network of trails and walking and biking trails. I've worked on that since 2015, 0 money. That's not my objective there. My objective is to make our community a better place. That's the end. That's the goal, is that you have these things you want to do with your time. And the point of your whole real estate portfolio, of a small and mighty real estate portfolio, is to own the least number of properties that can get you to those goals. You want the least number of properties, not the most, because the more properties you have, the more hassle you have, the more risk you have, the more things you have to think about at night, just that are on your mind, the more complexity you have. It's not that it's not possible to have a big portfolio and make it work. It's just that it's a lot harder, and it's not necessary. You don't have to do that. And so the whole point of this episode and the techniques that we're talking about, whether it's strategic refinance, whether it's paying cash for new properties, using a debt snowball, or buying more than you need and selling off the excess, all of those are tools in your toolbox that aren't talked about enough because we're focused on the BRRRR strategy. We're focused on subject to. We're focused on leveraging. And those are great tools, but a small and mighty investor knows that once you get to the point where you want to transition to live off your properties, you put those tools back in the toolbox, you pull out some new tools, and you start going to work on executing your portfolio in a way that optimizes your life, not always optimizing the return on an individual property. So that's the big meta lesson here. It's one of the big meta lessons of the book, The Small and Mighty Real Estate Investor. I hope you found this helpful. I hope you find the book helpful. If you haven't bought it yet, the book is available on biggerpockets.com/small and mighty. I'll have a link to that in the show description, also in the podcast description or the show notes for this episode. And if you're curious whether the book will be coming out on Amazon, Barnes & Noble, other places, Audible, yes, it will. It'll be later on August 22nd, where you can get it there as well. But I encourage you to go to Bigger Pockets. That's where you get a lot of the bonuses. That's where you can get the best deals. If you use the coupon code CHAD when you check out, you can get a 10% discount on the Bigger Pockets store. And there's also some really cool bonuses that I think you'll like, including a bonus chapter to the book, How to Be a Small and Mighty Real Estate Investor in 2023. When interest rates are higher, when things are changing, of course, we got to use different tools. We got to adapt our strategy. And there's some other cool bonuses that I think you'll like a lot. I appreciate your support. I appreciate you listening to the podcast, and I look forward to seeing you in the next episode.